Well, hi, this is Danielle DiMartino-Booth. Welcome back to Down the Middle. I'm in red today. Are the markets in red? That's a good question. In any event, I am so excited to have Peter Cecchini with me. He's the Director of Research at Axonic, but he has had a long and storied Wall Street career. And I learned something about Peter, and that's that he was a lawyer at some point. So I'd love to go back and get a little bit of your history and what landed you in finance and eventually here at Axonic, and what you like about Axonic's investment philosophy that drew you to the company.
Sure. It's great to see you, Danielle. Thanks for having me. Always great to catch up. It has been a while that I've been doing this. I did start out as a lawyer. I graduated from law school in 1995, and thereafter did a brief stint in banking, and then moved quickly into consulting, a private firm that consulted for the Department of Defense as well as manufacturers that sold to the Department of Defense. And it was a very interesting 5 or so years where I was focused on a lot of different topics, but became really interested in geopolitical issues. Mm-hmm. But I always had an interest in finance, starting with the internship that I had mentioned. And after about 5 years as a consultant, I decided it was time to get back into it. Went to Columbia Business School and graduated on the heels of a recession. And so, it was in 2002. And so I ended up working for a distressed hedge fund, which was eventually purchased by Mellon Financial, and then ended up running the liquid distressed group there. Did that for a few years and then started my own hedge fund. And from there, the financial crisis happened, and small funds weren't able to really raise a lot of money back then. And, our cost structure wasn't quite right either. And so we wound it down, and I ended up at Cantor Fitzgerald as a result, and spent 10 years there as the global market strategist. And it was a good 10 years, but I really had an itch to get back to the buy side. All this, of course, happening in the midst of a pandemic.
Of course.
And Axonic, the founder's name is Clay DiGiacinto. Mm-hmm. He was a client of mine, and we worked closely together, valued each other's intellect, and after the pandemic sort of ran its course, I guess it really hasn't yet, but when things calmed down a bit, right, we decided it would be a good time for us to start working together, and he hired me to come in and do a number of things. I'm the director of research here, but I'm really focused, obviously, as I was at Cantor, on markets and the risk that those markets pose potentially to our portfolio. And in that light, I'm always thinking about risk mitigation strategies and how we can make sure that our books are well protected against both known and unknown risks. So I help out with that. And of course, I do things like this to try to help make Axonic a little bit more of a well-known brand. Mm-hmm. And, of course, happy to talk a little bit more about Axonic specifically when you're ready.
Well, so I do like that. I do like the idea of approaching investing with risk management in mind, especially in a world when for so many years now, you just need to just be out there and be long, just in general. Yeah. Just go be long. But we've had an extraordinary run in markets, and you rightly have identified, if you will, kind of this. And there's actually a number for it. 43.2% of GDP was jammed into the veins of the economy in the space of 18 months. And that really culminated in April. And it shaped your view of the stock market in particular headed into 2021. You saw what was coming. Walk us through this kind of fiscal thrust, because I don't know that there's a great enough appreciation of the role fiscal has played because everybody says the Fed's got your back. But this really didn't have as much to do with the Fed, I think, as the average investor perceives.
Yes, yeah, that's exactly right. And frankly, it also shaped my choice for coming to Axonic, because I felt that we were going to get an inflationary thrust. And Axonic specialized, we're a multi-asset manager of about 4.6 billion. And we specialize in structured products, which includes, CMBS, RMBS, it's direct lending, aircraft ABS, for example, but collateralized cash flowing assets. We have quite a bit of exposure to multifamily. All of these sorts of assets tend to do better in inflationary environments. And I really felt like while people have gotten very comfortable with equities for over a decade as an asset class in which one simply couldn't lose because of the Fed backstop, felt like the free lunch was probably going to come to an end in the near future. And the lunch lady's name is inflation, and inflation is going to demand her fair share of forward returns. And yes, the fiscal impulse in particular was extremely important. There are really, I think, at least based on my work, two things that lead to an unusual situation in which one could get inflation, right? And for context, I had really been in the disinflation/deflation camp for a very long time. And it was only until these two sort of conditions showed themselves to be real and manifest that I got worried about inflation. You can look at inflationary episodes, and they usually happen during times of war. And there are two things you get. You get massive deficit spending, which leads to massive expansions in both private and public lending. We have that now. And an inorganic, if you will, demand impulse. And then you also get supply chain disruptions. And interestingly enough, in this case, those supply disruptions are even more prominent and important than they were during wartime. Even during world wars, there were parts of the globe that weren't particularly affected. But in this particular instance, there's almost no escaping the shortages and supply chain disruptions that the pandemic has caused. And so with those two pillars of inflation in place, I started talking about it in February, March of 2021, and it was met with a very, very cold shoulder from just about everybody, because inflation is so unusual.
Well, for our entire careers, it's we've seen falling interest rates. That's what everybody's used to.
That's right. And look, I think the other thing that this episode seems to be proving, right? And I don't think you can ignore well over 5% CPI, and we just got core today at 4.3. I don't think you can ignore the fact that that monetary policy, both in Europe and the U.S. and Japan, has not been successful at catalyzing inflation. And near the zero bound, there's not a heck of a lot that developed market central banks have left. So really what was responsible for this inflationary impulse, in my view, was fiscal policy. Now, that creates an interesting question, right? We have the $6 trillion. It's made its way through the system in large part. And, we can see that in a bunch of different ways. We can see it through the diminution in household savings. We can see it through the cash balance in the Treasury General account.
Right.
So from that perspective, potentially, there won't be as much of an inflationary problem going into next year. However, the supply side dynamics are arguably even worse somehow than they were, with an energy crunch beginning to manifest both in China and in Europe, and potentially that can bleed through to the United States. Coal prices and natural gas prices are at all-time highs. Coal at $216 a metric ton, natural gas at the equivalent of something like $100 a barrel in crude oil terms. So these things have me continually concerned that inflation will not abate. And one of two things will happen, right, Danielle? I mean, it'll either be that inflation kills itself off because demand will fall on higher prices, or the Fed will finally be able to act, or will finally be forced in a way to act by tapering very quickly and hiking rates potentially before anyone might have expected. So either way, inflation is going to end up being transitory. I think that's transitory inflation to me is a very tautological term. Of course, it's transitory. It
Right.
can't hang around forever because it either dies, kills itself, or a central bank will kill it. But in the meantime, for stocks, and not all stocks, not every single sector, but broadly speaking, inflationary episodes throughout history have not been good for the riskiest assets, including stocks, and have been much better for hard assets like housing, like commercial real estate. And so that really has been the focus of much of my work of late.
So you've made an interesting observation. If we could go back to kind of what drove the spending, and you mentioned the role that social media played, and it was really extraordinary to see the lines. I live in Dallas, Texas. You live in New York, but there were lines around the Gucci stores. There were lines around the Chanel stores. There were buzzes all over social media when these big stimulus checks would hit, via direct deposit. I mean, there's nothing as direct, but it was interesting that you actually made the connection. I never thought about it between social media and how quickly prices rose.
Yeah, I think there's two things to unpack there. The first is that we've never seen fiscal stimulus of this magnitude, six-ish trillion so far, not including what might be coming, which I think will be far less effective, by the way.
Right.
Because, as you pointed out, much of it was in the form of either direct deposits into consumers' checking accounts or direct lines of credit that businesses could buy. Mm-hmm. And importantly, through this little thing called Section 13.3 of the Federal Reserve Act, it was a combined effort, an arm-in-arm effort between the Treasury and the Federal Reserve. Effectively, you said it this way at one time, which I really liked. Basically a leveraged buyout of sorts where Treasury funded these special purpose vehicles. Right.
It was a leveraged buyout of corporate America. I mean, that's really what it was.
Funded. That's right. And I loved the way you said that, and it resonated with me. And that's really what it was. And it provided almost an implicit guarantee for corporate America for a time. And that's one of the reasons why credit right now is not really the same sort of leading indicator that it has been in most cycles, because I think there's just so much confidence that no matter what happens, the Fed and the Treasury will step back in again. Mm-hmm. And that has obviously sort of reflexively continued to support equities. But again, you can't get away from the fact that that fiscal impulse that you mentioned will have an impact that I don't think the Fed will be able to escape. And by the way, equities took on a life of their own, which is another reason there's such a disconnect between the credit markets and equity market through social media. And meme stocks in particular are sort of, they're the emblem, they're the badge for the irrationality in the markets. When you look at how they became, in a way, how equities became the tail that wagged the credit market dog, something that I never thought I would say. You look at something like AMC or GameStop. When AMC was essentially able, for at-the-money equity offerings, able to issue well over $1 billion in shares, which liquefied the company and enabled them to refinance essentially all of their debt. Yep. And there were even headlines today that they're going to be buying back first lien term loans. So, all of these things combined in a radically different way this cycle. So, cycle analogies.
I'm sorry, but meme and Reddit and chat rooms and kids in their parents' basements playing with stimulus money and robbing. I mean, this makes day trading look like it was something really boring in 1999.
Yeah, it's the Gen Z version of the day trading that the Gen Xers were doing in the late 90s, right? It's on your cell phone, it's in your pajamas. It's it's sort of the Tinder version of it, right? It's you're just swiping this way or that. Oh yeah, that's I heard on there's no analysis in this. So investing has really changed
No, I mean, I'm going to interrupt for 2 seconds because
please.
One of the meme stocks got murdered, and I'm at Bed Bath & Beyond. And I'm sitting there thinking to myself, you've got a 17, 20-year-old kid who's like, this Bed Bath & Beyond's the hottest thing in the world. And yet they couldn't probably find a Bed Bath & Beyond if you paid them money, nor would they know what to do if they stepped inside one of them. So it's just...
Or Reddit traders, flying banners to buy AMC stock across beaches during the summer. I mean, this happened. It's truly incredible, and it either means that things have changed for good and fundamentals will never matter again, or they haven't. And I'm obviously in the or they haven't camp, because this isn't the first time we've seen insane kinds of behaviors. And I've actually likened it not to the tulip bubble, because that arguably wasn't actually all that broad a phenomenon back in the 1600s.
With no Twitter.
The South Sea bubble is an interesting analog, because the people who wanted to buy South Sea Company stock wanted to be like the elites. And they were given the opportunity by the elite, to participate in something. And it's kind of the same thing here, like this quote unquote democratization of finance that happened through Robinhood and the other stock boards like Reddit. It's not really democratization at all. It's over time, just, I think, going to lead to a lot of pain for people who thought they could never lose money in the stock market. Because at the end of the day, when all of this fiscal stimulus starts to fade and inflation takes its toll, it's going to be a much trickier environment in which to invest. And cash flows and intrinsic value will once again matter. It's always just a matter of time and how long you can last while the insanity drives the narrative.
So Peter, what you were actually just describing right now is what we have traditionally, all of our careers, referred to as retail participation. And I'm not sure if you remember the year 2017 in the markets. There was a lot of complacency. The VIX index, the fear index, was kind of south of 10 for however long it was south of 10. 52 times the VIX closed below 10 in 2017. But the missing element was retail participation. It wasn't there. And we've got retail participation this time. And I think that's why one of the reasons that you've had your eye specifically on small cap stocks on the Russell 2000.
Yeah, a few reasons why since May I've been cautious to use one word about small caps. And the first reason really was in inflation. Small cap stocks tend not to be able to pass through costs as readily as large caps. And that makes sense, right? Because they aren't as large, they don't have the same scale, so they don't have the same pricing power typically as a large cap company in the same space.
Sure.
The other reason for caution in small caps was certainly the fact that this same sort of meme-driven retail participation tended to concentrate in small cap stocks, and I already mentioned one name, AMC, which is a very in GameStop, but AMC is a large component of the Russell 2000, for example. And so those, if I'm correct, only time will tell, and we eventually revert to a world in which things like valuation matter again, then small caps are also at quite a bit of risk. And interestingly enough, to put icing on that cake, the recent rebalancing of the Russell, which I believe is about a month old, actually happened to add a lot of negative earnings companies to the Russell 2000. So if you look at the Russell 2000 in aggregate, it's barely profitable. Proponents of small caps would counter-argue, well, that's largely because of the pandemic. But it's a sort of a persistent problem for the Russell 2000 that it goes in and out of profitability even when there isn't an economic cycle in play.
Yeah, and I think that is truly the nature of small cap. And small cap is also to me at least, largely a reflection of the strength of the domestic U.S. economy. And that takes us right back to where we started this discussion, which was fiscal. So I want to get your views on it. I want to shift to interest rates for a second, because I think, did I read you right that there is a possibility that the nominal 10-year note could go to the zero bound? That has to have been a typo. And actually, I only say that partially tongue-in-cheek because you can draw out a lot of scenarios, especially later on when we talk about China and Europe and energy and a global slowdown. You can paint the picture. We did see the 10-year at 1.2% earlier this year. But so talk about nominal yields downside and why you recently took where you think the 10-year could hit also down in terms of the top end of your range, because they're related.
Yes, they are. So as you know, we've been in an almost 40-year secular downtrend in rates, both in Fed funds as well as 10 years, right? 10 years, obviously, for a long time was affected by second-order impacts of Fed policy. And if we think about mathematically what the 10-year yield is, it's the geometric average of short rates over time. And so you can actually make a case if you thought that short rates were going to be at zero with complete certainty, then logically it would have to follow that the 10-year would be at zero. So what then is term premium? We think about it typically, Irving Fisher's theory of interest rates thinks about nominal yields as real yields plus some expectation for inflation. And I've come over the past year or so to the conclusion that that's an anachronistic concept for a lot of different reasons. And QE is really that reason. And we, in fact, saw when the 10-year went to 1.17% at one point earlier in the year, we saw the fact that inflation was clearly in the numbers. But for some reason, rates were falling, not rising. And the reason for that is that the Treasury market has become less of a market and more of a social policy tool, because the QE allows the Fed to act directly on long yields. And that action has basically killed all the bond vigilantes that used to actually sell bonds when they thought that there was going to be inflation.
It's funny, you were literally echoing Charlie Plosser, former president of the Philadelphia Fed. He literally made a similar statement when he was comparing when he started out in monetary policy and what happened in the post-QE era. So my hat's off to both of you. So I'm sorry, continue.
Yeah, well, look, I hate to say it because I don't agree with the policy prescriptions of this school of thought. But Warren Mosler, who's known as the father of MMT, wrote a paper, I believe in the late 90s, and it said the natural rate of interest is zero. And he made, I'm not going to get into the arguments he made, but frankly, I'd been in the camp that the natural rate of interest was trending towards zero for slightly different reasons than he did, but mostly because, in my view, over time, it's a self-fulfilling system. That is to say, when the macroeconomic policy effect of monetary policy comes from lower rates, not low rates. And so if you're going to achieve a macroeconomic outcome, rates actually have to move lower each cycle because the markets, the economy, as well as the financial markets, they reach an equilibrium at whatever that new lower rate is. So in order to get a renewed or incremental macroeconomic policy effect, rates have to be lower still. So what happens when you hit the zero bound? You can't achieve a macroeconomic policy effect unless you move out the curve and take out term premium, which, coming back to what I said a little bit earlier, is really more a reflection of the Fed reaction function to things like inflation than it is a direct result of inflation itself. That is to say, rates could remain, the 10-year yield could remain a lot lower than inflation would suggest if the Fed decided it wanted to continue to buy bonds. If it decided it wanted to buy it wanted to create reserves to buy the 10-year, it could, at its own peril in an inflationary environment, continue to keep rates low or yields low while inflation continued to run hot. And that's what the scenario I alluded to earlier, where I said one of two things can happen. Either the Fed or a central bank can react to inflation, or in fact, inflation can kill itself by killing demand. Right?
But we call that stagflation, though, don't we?
Yeah, I hesitate to use the word stagflation because it is such a loaded word. And, literalists can say, oh, he's talking about stagflation of the 1970s. That's absolutely ridiculous because we still have quite a bit of GDP growth. I think it's splitting hairs, but I've avoided using it, not to say it's not a useful analog. It just might not be history rarely repeats, but it tends to rhyme. So there are definitely parts of this piece of music that rhyme with the 70s, but there are other parts that don't. And the fiscal stimulus impulse is the part that doesn't. And maybe that's a good segue to come back around to what that looks like going forward.
Well, so before we do that, you say that the Fed is in denial.
Yeah.
Because, if inflation is allowed to grow out of control, and home base, for example, the St. Louis Fed put out a piece that said that September non-farm payrolls could be negative 500,000 or negative 810,000 based on a model of a real-time company. All they do is track employment moves, people in and out of buildings. And it's a model that the St. Louis Fed has found to be very helpful over time because it's worked, as opposed to, let's say, ADP, using that as a leading indicator. Not to pick on ADP. Jay Powell has said that the tapering is effectively contingent upon September payroll growth, whether or not they'll pull the trigger in November. But everything you've just described suggests that regardless of what payrolls are going to do, inflation's going to continue for some time. So, again, how long can the Fed stay in denial?
For however long it can stay as woke as it has been, right? At the end of the day,
yes.
This is what's happened, okay? And look, I'm not taking this conversation down the political route, and I don't mean to by saying that. But what's clearly started to happen is that the employment mandate, which is a much easier mandate to wrap one's social policy arms around, has become more important than the inflation mandate. And the reason for that is because it's hard to know you've had deleterious impacts from inflation until after the fact, right? And no one's going to, the Fed's going to say, well, inflation is such a rare thing, but unemployment isn't. We know we can do something about unemployment, and we want unemployment to be low across demographic groups. And we're going to make sure that we maintain easy policy until all groups are employed. But we're not going to worry much about inflation because, number one, it hasn't existed. And there's a case to be made that it's not something we need to worry about in the long run. Now, that's the thing that kills me about this transitory tautology, right? In the July 17th, I believe, presser that Powell had, he said, we're only going to be worried about inflation if it changes the process of inflation over 3 to 5 years. Well, I don't know, maybe I just don't get it. But if we have to wait 3 to 5 years to know whether or not inflation has had an impact, isn't it too late? So it seems to me like the Fed has effectively jettisoned the inflation part of the mandate because it's less popular, if you will, than making sure that they can get employment to whatever level they decide is full employment. Maybe that's zero. I don't know. But I do think it's dancing with the devil to ignore inflation because inflation can have an impact on employment as well. I think that's why I made the statement that the Fed is sort of ignoring it at its peril.
And it's really, really interesting you say that because you've been keeping a close eye on the saving rate. And we found out that in August, the saving rate fell down to 9.4%. So we're back into single digits on the saving rate. We had been, it obviously had spiked when all of this money was flowing into the economy. Other work that's been done by the New York Fed, for example, shows that the bulk of the marginal savings that still exists is in the hands of people in their 50s, 60s, and 70s. So, and we've still got this inflation saving rate back below 10%. Where's the spending capacity going to come from? I mean, can you talk to me about the idea of pulling forward demand?
Yeah, sure. One of the things that I pointed out in a recent piece, was that in fact, household savings in absolute terms were now below pre-pandemic levels, slightly. And, that could indicate that impulse that drove consumption is now gone. And I think, the question then becomes, how quickly can organic recovery replace the inorganic demand impulse, which clearly pulled forward lots of demand. I just don't think that there's any way that can be a seamless transition from $6 trillion of stimulative demand impulse directly in the pockets of consumers to a recovery that's going to take time. And by the way, I think one of the other things that's being ignored, in addition to the import of $6 trillion of deposits, not completely, but into people's checking accounts, is the fact that 2019 was a slowdown year. We saw, loan growth falling off into the end of 2019. Yep. The economic data didn't look that great. And that, by the way, began at the end of 2018 when there was a 20% swoon in the equity markets. On the 10-year yield, in my view, this was the driver, on the 10-year yield rising to 3.25% or so. Yep. And the yield curve inverted and the economy slowed. And so this idea that we were somehow on a gangbusters growth trajectory before the pandemic hit, I think is an incorrect assumption. And so to think that we're going to go back to some blockbuster level of pre-pandemic growth doesn't make an awful lot of sense to me.
It doesn't. And, something that Lacey Hunt taught me, and I've spoken to him over the years, is that if global trade ever contracts for the full year, the United States is heading into recession. And he just went back to me and showed me the examples and the double dip recession of the 80s, et cetera. Well, global trade contracted for the full year in 2019. So that train had left the station, but there are a lot of denialists, especially in your world, who call it the pandemic recession. Well, the pandemic recession created a heck of a lot of fiscal stimulus, as we know. So a mutual friend, Peter Bookvar, noted that if you adjust for inflation, I think people have a hard time grasping the idea of real or inflation-adjusted data. But he made the comment: if you adjust for inflation, and you look at the combination of July and August consumer spending in the United States, it was flat as a pancake.
Yes, that's absolutely right. I agree with that analysis. And moreover, I've never seen this happen before, when you look at high yield real yields, for example, they're deeply negative. So, and again, this is where it is important to try to understand how long inflation is going to last, because people can't tolerate negative high yield returns for much longer. Something has to break, something has to give. And it doesn't necessarily guarantee that in order to get that yield, people are going to migrate to equities. When I think, again, coming back for a second to equities, margins are at their peak, and inflation likely, and especially again for those companies not well positioned to pass it through to the consumer, will compress. And I think that's a very big risk when thinking again about how inflation sort of when you take inflation into account, as Peter did in his analysis, really changes the entirety of the analysis.
It does. I read a commentary a few days ago that said, a record number of companies had mentioned inflation in their earnings conference calls. And therefore the inflation, it's already priced into the market. That may be the case, but the margin compression that you note that's coming is certainly not priced into the market.
Yeah, I think that was probably my morning note, because it was, it's interesting to see, you could see it anecdotally. large multinationals were starting to point it out, PPG, et cetera. And it was tough to actually try to aggregate that. And in fact, our friends at Bloomberg came up with a tool that enables one to do that and actually go through earnings transcripts and actually try to quantify that.
Yep.
And it's not just at an all-time high, it's at a considerably higher all-time high. And it's not to say it's going to abate, because the way companies typically do this is they'll test the market, right? So they'll raise prices by a little bit. They'll see what the impact on demand is, and they'll do it again and again and again until they feel like they can't do it anymore. And so I think that's just the beginning. And companies are in fact signaling that in their earnings reports, but it doesn't mean it's priced in. It simply means that there's likely more to come.
Yeah, I mean, I was shocked at how shocked the market was when Cox Automotive came out and said, well, nearly half of would-be car buyers in the United States are suffering from sticker shock, so they're postponing their plans to buy a car. Oh, and by the way, car prices have been at record highs for 5 months in a row. And I'm like, you can't look at those two in isolation. That's impossible. No. I mean, car prices have never, ever been, new car prices, as high as, and it's clear that the manufacturers are they're just, like you said, experimenting.
Well, personal experience for a second. I'm long too many cars as it is, but I have a car that I lease, which I use here in the city. And it's coming off lease, and I thought, boy, I must be in the money on my lease residual, and they should be able to credit that to a new vehicle,
right?
And or obviously, if you're in the money on your residual, you can, buy the car out of your lease, right?
Right.
And sell it.
Sure.
Okay. And make some money. That's a hassle that none of us are going to do for $5,000 or $6,000, right? $10,000 even. But the bottom line is, you're not going to get a better lease deal on your new car. Because, in fact, new car prices, manufacturers are not stupid. They're raising new car prices so that you can't arb your residual. Of course that's what happens, right? So, and by the way, it's not just cars. And much ado was made a couple of months ago when CPI came out 0.1% lower than previous print. And, then PPI came out on the heels of that much hotter. And what the PPI print showed, and has continued to show, is that inflation is actually broadening. It's not just used cars and computer chips. It's moving into lots of other areas. And if you look at PPI, which tends to lead CPI by a little bit in terms of the way that broadens,
sure,
it doesn't feel like inflation is abating. And I think the core number that came out today supports that. Alongside, by the way, the New York Fed's own surveys for future expectations of inflation, and Michigan, which I think has been ahead of the curve on people's expectations for both 1 and 3 to 5 year inflation.
You've been saying that the University of Michigan kind of defies what Jay Powell has been saying at the podium, and that is that U.S. households are aware that inflation has arrived. And that it's something that is tangible to them. Yeah,
I mean, there's a piece, not to get too nerdy about it, but there's a piece of the survey
let's get nerdy,
which actually,
Peter, come on,
which says, how do you feel about your income keeping pace with prices? And people overwhelmingly responded, their income is not keeping pace with prices. Mm-hmm. Full stop. And, again, you can see this anecdotally, and it's likely going to affect low-end consumers more in a lot of ways. But for the first time in a very long time, Dollar Tree said it was going to raise its prices above the dollar price point. And we all know that's kind of a silly thing, the dollar, whatever, but they're raising prices. And that likely means that other low-cost retailers are going to raise their prices, mm-hmm. which means that the higher margin goods that they sell, that Hello Kitty pen, you were there with your daughter or whatever, and she said, oh, I love that. Can you get that for me? Sure. If you're spending a lot more money on the necessities, you're not going to make that impulse purchase, which, by the way, that's where they make all their margin.
Right.
So, I think that process of companies just starting to raise prices, we're in the beginning of that, not at the end quite yet. It takes time for it to make its way through the value chain fully to the consumer.
Well, So this kind of leads me to the subject of jobs, and I'm intrigued. You said that Twitter is toxic, and I'm just going to share a little story. So every single time I'm on Twitter and mention that, the job market might those 10 million job openings that might over advertise what's happening in the job market, and in fact there might be weakness coming down the pipeline because companies don't just take margin compression sitting down. They try to, in addition to raising prices, they try to cut costs. And so we have seen a lot of automation, but the reason I bring Twitter up is because every time you put it out there, that anything about wages, you get these nasty answers that say, well, then it's time for corporate America to pay up, and it's past time. But that doesn't really work when you have shareholders involved. And so I'm curious what your outlook is for the job market, given we've got, we've just had initial claims go up for 3 weeks in a row, state initial claims. Where did that come from? So I'm curious what your outlook is there.
Yeah, look, social media is what it is. And generally speaking, if your narrative is even slightly to the right or the left of the popular narrative, especially when it comes to the stock market or jobs or whatever, the attempt to cancel you is quite great, and oftentimes just not worth the time to even participate in the nonsensical dialogue that occurs.
Oh, yeah, that's true.
Yeah, so look, there's always been a tension between capital and labor. So I'm not surprised that that is the reaction in social media to whenever the topic comes up. It is a long-running tension that literally underpins the difference between socialism and capitalism. So look, can companies continually pass through benefits to workers at the expense of profits? Clearly, the answer is no. I mean, that's obviously would be an extreme situation. But companies clearly have to walk the line to make sure that they reward workers for their productive endeavors. And there's nothing wrong with that. A well-run company should compensate its workers well. And at the end of the day, that I don't think is at all inconsistent with the goal of rewarding shareholders for their investment. And so I think there's actually a large overlap between the interests of capital and labor. Capital cannot earn a long run return without labor. And likewise, labor will not be well compensated without capital. And so that tension is a good tension in a lot of ways. Unfortunately, in situations where you have inflation, it brings that tension to the forefront, because rather than be a win-win between capital and labor, it feels much more like a zero-sum game, right? And that's the problem, because at some point, if inflation is severe enough, companies have to either raise prices or try to cut wages or do something else to maintain their margins, because they do have a fiduciary obligation to shareholders. And so that's the really tricky part of managing as a company's management in an inflationary environment.
Well, and we're definitely, as you said, closer to the beginning of that process, which I think is underappreciated. But shift gears for a minute. Everybody says the dollar is going to hell in a handbasket. What is your medium-term outlook for the dollar, given where you think rates are headed?
Yeah, I've been a dollar bull for some time. Last year in particular, people were concerned that the dollar was going to depreciate significantly. The most important thing I think to recognize is that, especially in a global crisis, currency crosses are relative value assessments. And at the end of the day, there is and probably will remain for some time, whether other economies like it or not, there will remain a global dollar shortage, a structural shortage of dollars, based on the way the world reorganized after World War II effectively. And of course, rate differentials matter. But the fact of the matter is, relative to developed market currency crosses, rates in other developed economies like Japan and Europe are much lower than they are in the United States.
Yep.
When it comes to emerging market economies, a rate differential comparison can't be made directly because you have to then introduce a new concept, which is risk premium, right? So when your risk of owning one currency versus the other is unequal, then you have to take that into account. And so relative to even emerging market currencies, I think the dollar will remain well bid because there's not going to be enough in this kind of environment where there are a lot of tail risks to COVID and otherwise. And especially because there's inflation, which can just absolutely demolish emerging market economies, the dollar will likely remain relatively well bid. Even if my thesis over the long run were to be that rates tended towards zero. And by the way, just to clarify, the shorter term view is that rates will continue to grind higher on taper, but moderated by the fact that in this particular instance, right, taper is not the taper of 2018 where the Fed was shrinking its balance sheet. It's simply fewer asset purchases, meaning the balance sheet is growing less quickly, right? So it's a very different kind of taper. So moderated by that to some extent, but also moderated by the fact that an equity risk off, which could come from things like margin compression, would likely catalyze capital flows from equities into things like the long end of the U.S. Treasury curve, which is one of the few places you can get any sort of risk-free return that has a positive nominal yield. Forget about the real yield.
There seems to be a small little energy crisis brewing around the world. I actually caught a Bloomberg interview in which you were sharing some of your views on energy, but it's start here in the United States, and then take us out to Europe and England and China, and what some of these rising energy prices as we head into the winter. What that can possibly mean for inflation, but also in the grander scheme of things for the global economic outlook.
Yeah, and look, I think the energy shortage is part and parcel of the supply chain disruptions that we've been concerned with for some time. So it doesn't necessarily come as that much of a surprise, but clearly coming into winter, seeing what natural gas prices are doing and seeing what coal prices are doing, it has great import. Fortunately for the United States, only about 20% of our energy needs are served by coal now. But in China, it's very much not the case, whereas between 50 and 60% or even higher perhaps of their energy needs are met by coal. And their need for coal is what's driving coal prices higher. And in much of the world, the baseline provision of energy is still coal. And so that has a real impact on the cost of everything, right? The cost of manufacturing widgets to iPhones. And in fact, that was one of the headlines I came across just a few days ago, that one of the supply chain partners for Apple may not be able to deliver on iPhone supply because of the energy curtailment in China. And so that's how these energy supply shortages can affect everything from not just how much it costs to heat your home in the winter, but the price of an iPhone or its availability. It goes much deeper than just your heating bill and how much it costs to fill your car's gas tank.
So it's interesting that you framed this because a few days ago I published about the effect that the Olympics coming on the 4th of February in China, that's really going to make this energy situation go from bad to worse because they have to clear up the smog in Beijing. which means, I mean, the rest of the country can be, smog filled and it's regular, but they have to use alternative forms of energy until they get through the month of February. So I'll just add that little twist, if you will.
That's interesting. That's an interesting point I hadn't considered.
Yeah, if you look back at 2008, we saw a very similar run-up to the Summer Olympics in Beijing. But bigger picture, China is still the marginal buyer of commodities worldwide. It is what it is. So
yes.
How should this affect our outlook? I would say near term for commodities. I'm talking about commodities outside of natural gas, coal, anything energy related, energy commodities.
Yeah, well, it's interesting. We talked a little bit earlier about how rates markets have changed because of the Fed's participation. Mm-hmm. Since the end of the GFC, if anybody can remember that far back, China really took on a new role as a world power and grew gangbusters after the Great Financial Crisis relative to developed market counterparts. And it really took over as the world's biggest consumer and producer of most commodities. When you look at copper, more than 50% of the world's copper is produced and consumed by China.
That blows me away.
Yeah, coal, same thing. You could name a half dozen commodities. And so, copper in particular is an interesting case because, people used to refer, and some people still do, but people used to refer to it as Dr. Copper because it was supposed to tell you a lot about what global supply and demand looked like at any given time. Mm-hmm. For better or worse now, a big move in copper probably has more to do with what China is doing and whether or not there has been a decision by central authorities in China to buy or sell copper. And they typically will stockpile commodities they feel like they may need. So if they're right about the global demand forecast, then perhaps it does presage an increase in demand globally. But they may be doing it for other reasons as well, because they don't think just next quarter or even next 6 months. They're thinking, how much copper do we need for the next 3 to 5 years? How much coal do we need for the next 3 to 5 years? Do we need to stockpile this? And copper also serves another purpose in China, which is contract for difference collateral. And so it's also something of a financial asset. So all these things are, right, a little bit more complicated to analyze than they were 20 years ago before China took such a prominent role in the commodity markets.
So bring all of this together. You're not. I don't want to paint you as a bearer, like in every corner of the market. You're pretty sanguine, especially when it comes to. I'm looking out, the back of your window, and I see shadows of buildings. You're pretty sanguine on multifamily. Can you talk a little bit about that thesis, given we see Castle with a K? The office occupancy in New York is 29%. It's lower than that in San Francisco. The highest it is in Houston and in Dallas, and that's 50%. Mm-hmm. So help me square that circle in terms of your bullishness on multifamily.
Yeah. Well, look, it's actually been a view I've had for some time, even before I arrived at Axonic. And of course, it's core to what Axonic does, but we're not just buying multifamily anywhere, right? One of the nice things about the real estate market is it's a market which has geographic specificity and idiosyncratic characteristics, which investors can take advantage of, unlike a lot of public markets right now, which make no sense. And multifamily in particular, if you choose the right geographies and the right securities with which to express the view, can provide a very safe cash flowing alternative to just about anything else that has the same yield. And the multifamily thesis is certainly well supported by the fact that housing prices have gone up 20% year over year. Mm-hmm. And that lack of affordability is driving people into multifamily as renters. Mm-hmm. And as a result, both the collateral values for existing multifamily properties in which we're invested, for example, or indeed for stuff that's coming down the pipeline is more valuable because rents are rising with home prices. And interestingly, this comes back to the inflation discussion that we had earlier, which is to say rents, owner's equivalent rent really hasn't risen with home prices yet, but it will, because it always does. It does it with a lag, because obviously people usually have 1 to 2 year leases. And so it takes a little bit of time for those higher house prices to actually bleed into rents. But that's one of the things we like about the outlook for multifamily. The fact that we think in the right markets, let's not talk about New York and San Fran and some of the others, but in the right markets, which we do deep fundamental analysis to identify, we think that rents are going to go up.
Interesting. Good. And because there's still a lot of supply coming online in the wrong places. Yes. And that's why you're pointing out location also applies, to multifamily. But the other aspect you bring up is kind of how ridiculous the Fed's view of inflation is, because there is such a long lead time between when home prices, which we were told by Kay Schiller, were going up 19.7% all time, and apartment Class A rents are going up 10%, double digits right now. So, but it's to me, it's almost insulting to investors to say it's all supply chain, it's all transitory. I mean, in July, how many times did he use the word lumber? Because it had come off of its highs, which it's still 34% higher than it was. But anyways,
thank you for pointing that out.
Well, I mean, thank you. Yes, but it just seems a little disingenuous to deny that housing plays such a large role. It's 40% of the CPI. Lucky for them, it's half of that in the PCE. Very convenient, but it's still very real, and I think that it goes back to University of Michigan and households' awareness.
Yes, look, people need to sustain themselves, and the two basic things they need to sustain themselves are food and clothing, of course, and housing. And so in the right markets, there is pricing power. And interestingly enough, even in markets that you might think have an oversupply of multifamily housing, like, for example, you might think that work from home has decimated the New York City rental market. It hasn't. Rental prices for most sized apartments, especially the lower end, are actually higher than they were pre-pandemic.
Yep.
It's hard to believe, but it's absolutely positively the fact.
Well, I pound the table all the time because the media loves the work from home theme. But the Bureau of Labor Statistics will tell you that it topped out somewhere around 40, maybe 45%, and it's down to 13. So move on, people, because I think a lot of people have moved back into cities.
Yes, I agree. And by the way, we also think there's opportunity in office for that very reason. We think the work from home, narrative is overplayed.
Interesting. So let's step back and go really big picture, because I think your focus on fiscal is so critical, because you have to ask yourself what happens next. And I'll tell you about a guy by the name of Pat Toomey. So he's a senator who believes in term limits, and what few people appreciated about that late 2020 stimulus package was that he put stipulating language in the legislation that said that Janet Yellen, he was referring to whoever the next Treasury Secretary was going to be, but right now, in the case, it's Janet Yellen at the behest of Jay Powell, cannot flip the switch back on these credit facilities. There has to be
it well.
There has to be a new 13C. There has to be a new form of emergency. It can't just be, the credit markets are starting to fall out of the bed because they're finally figuring out that there's a slowdown in the U.S. economy without the fiscal thrust. So here's post-GFC, post-financial crisis, the Fed went at it alone and was able to successfully address liquidity, systemic risk, contain everything, get the ball rolling, quantitative easing, blow the markets back up, more financialization, blah, blah, blah. But this time it took fiscal and Fed policy. And so I don't know what's your philosophy about what happens if there's a hiccup? And I don't want you to be political, but as we're heading into what could possibly be a rancorous midterm election. I mean, what role will the Fed be able to play, I think is what I'm saying, if fiscal can't be there?
No, absolutely. And this has been a big part of my theme really since the beginning of the year. And, I started out the year actually fairly bullish of equities into July. In late July, I put out a piece where I said, we've become relatively bearish of equities broadly speaking. Again, there are pockets that we like. But that said, one of the reasons is that the Fed's ability, again, to affect a macroeconomic outcome near the zero bound, with both Fed funds as well as 10-year yields this low, is limited. When we think about previous recessions, the Fed was able to cut, on average, in a range of between 5 and 7% to affect the desired macroeconomic outcome.
Right.
And there's a misperception that the Fed doing QE in and of itself somehow is stimulative. It's not correct. The Fed itself, many within the Fed, have said the quantity of money is not what does it, folks. It's the impact on Treasury purchases that drives down yields. So what the Fed does is it creates a reserve, which becomes a liability on its balance sheet. It uses the new FRNs or cash to go out and buy Treasuries. And by buying Treasuries, it does two things. It creates demand for Treasuries in and of itself by the act of buying them, and also creates something of a scarcity in Treasuries for private buyers. And that lowers interest rates.
Right.
It's the interest rate mechanism that we have to care about. And there's just not a ton of room on 10 years. And by the way, when you get close to zero on the long end, it's not very good for banks. And so there are diminishing marginal returns because banks lend on a spread. So, at zero, you may have that stimulative impact of 10-year going from 1.5 to zero with respect to consumption and increased desire to lend and borrow. But the profitability of those loans is impaired greatly. So there's a huge offset. So
yeah, in fact, I'm going to ask you to send it, and we'll pop up the graph here in the end, because you've done some great work on loan demand.
Yeah, look, what the other misunderstanding is that somehow banks can force loans into the system. That's not the way it works. Loan demand creates lending and loan volume. There has to be a demand for the loans. And even during the pandemic, how come there isn't more uptake on some of our lending facilities? Well, because the demand wasn't there. You can't force loans on people if the organic reason for taking out a loan is not there. Then it's very difficult to get people to borrow. And in fact, you don't want them to borrow if they don't have a reasonable need for it, right? So that's really important, which takes us to I think your main point here, which is that it comes down to fiscal policy, right? And so with monetary policy very close to doing and having done everything it can, fiscal policy makers need to step up. And look, they did during the pandemic. And, you can argue it was a couple trillion too much or too little, but they did what they needed to do to prevent a complete catastrophe from occurring. The problem is, once again, there are no free lunches. At some point, you have to pay for that stimulus, and that it's either through taxes or through inflation. By the way, inflation is a form of a tax.
Right, of course.
Right. So what's going to happen next on the fiscal policy front is probably better left to experts in that area. But I will make a general statement, and I will say, whether it's 3.5 trillion or $1.5 trillion, 550 plus the trillion that Manchin is now discussing as being feasible, given his reticence to do the 3.5. It almost doesn't matter, Danielle, and the reason for that is because most of the money is going to be either pork barrel or infrastructure.
Right.
Now, I'm a big proponent of infrastructure spending. Don't get me wrong. I think it's great if it's real and it makes its way to projects. But two things. It's notoriously, again, pork belly. It notoriously does not make its way to construction companies who actually fix the roads and bridges. That's the first thing. And the second thing is it happens over a very long period of time. So if we're talking over 10 years, okay, $1 trillion, 100 billion a year. Okay, that's significant, but it's nothing close to the order of magnitude that we got with $6 trillion of relatively direct stimulus over the course of a year and change.
And I think we're going to end on that note, but that's something you said in the very beginning of our discussion is, but it's spread out. And you know that, I know that. I don't know necessarily that it's fully incorporated because people are like, we need that stimulus. It was 6 then, it can be 3 or 4.5 trillion now. But the critical distinction is when it's spread out all over time, and it's the big dig in Boston and using public unions and all of the different things you hear about every time there's major public spending projects, that's not going to have the same impact. And I think the fact that you bring that up and you weave the fiscal side into your analysis is so critical. So I'm enjoying your research. I'm happy you're at Axonic.
Same here.
I'm doing my very first post-COVID, post-FOMC, so that Wednesday, whatever that Wednesday is, November the 3rd. So I'm going to do my very first ideas dinner in the post-COVID era. So I hope, like you have in the past, you can join me and we can talk again. But thank you so much today for your views. This has been a great visit.
Thank you, Danielle. It's always a pleasure. Thanks so much.
Thanks. Take care.
Bye.
Bye. Peter Cecchini. I mean, what a great thinker. Such a great hour that we were just able to spend with him. And again, the takeaway here is it's not so much the fiscal spending. It's not so much what the government has injected into the U.S. economy in the last 2 years, call it. It's how it's been injected directly into the veins of U.S. consumers. And that compares really, it's a complete and total distinction from what we're talking about going forward, which is long infrastructure spending spread out over a decade. So I hope you enjoyed his views. I learned a lot. I hope you did as well. If you want to look at more of the geopolitical angle of some of the things that are going to be facing the global economy as we end 2021 and look to 2022, go back and look at the interview that I did. Watch the interview that I did with Peter Scheer recently in New York. And I think he'll give you some great insights on that front. And as always, I thank you for your time, and I look forward to the next Down the Middle. This is Danielle DiMartino Booth.